after this.
Right. Let me ask you about a commodity called oil. To what degree, I mean, the focus has been on debt and so forth. To what degree were commodity prices, particularly oil, played a role in the downturn we're in? And what happens in this to commodity prices in this kind of environment that you're all describing?
Well, in my view, the financial crisis would have led to a severe economic contraction, regardless of that very sharp increase in oil prices all the way through the middle of last year, even if, of course, with oil peaking around 145 around July, that was the extra kind of thing that, especially for the oil-importing countries, implied a significant reduction in purchasing power. But certainly, you know, the credit crunch and the housing bust and the liquidity crunch had a much bigger role. Since then, of course, you know, oil prices have fallen by something like 70% plus. In my scenario of a very severe U.S. and global recession, I expect oil prices, even from current level, to fall slightly more. You know, we have an estimate for oil prices this year in a range of, at best, 30 to 40. But if this recession becomes even more severe, you know, you have an elastic supply in the short run, fundamental demand is falling, the price adjustment is to be large, and all the speculative demand for oil that was based on rising oil prices now is falling apart. So I would not be surprised if at some point this year oil prices could fall well below 30 as we expect a severe kind of economic contraction. For a moment, there was a few weeks in which people believed that maybe there'll be a recovery of China faster than otherwise. That's going to lead to a rally in commodity and oil, that China could again decouple from the United States. I think the latest number this week about the imports and exports from China have dashed that expectation, and all the numbers from the U.S. about what's happening to the economy, initial claims, employment, suggest that, you know, the two key engines of global growth were United States and China. The U.S. one, the engine has fallen off, and the one of China has essentially stalled, to say generously. So I see in this situation further weakness in oil prices unless the OPEC is able to maintain the cartel and really cut production even further and maintain that kind of a reduction in supply, something I think is going to be unlikely. I would not be surprised if oil at some point could go towards 20 this year.
You guys want to come in on commodities?
In one sense, I kind of agree with what Nouriel's saying. I think in the near term, the risks are definitely on the downside. But coming back and tying this question to the China question, I guess I think just given the low levels of debt that China now has, I think the scope for them to stimulate and keep stimulating for a while is high. I agree with you. That doesn't give you sustained sort of long-term growth. But I think they have a lot of scope to do that. Similarly, as you're well aware, they've been twisting the arms of the state-owned banks to lend like crazy. And so I think a combination of those could eventually bring sort of China out of this, and that might give a little more upside to oil, maybe not this year, but next year, so that after hitting, you know, 30 or even lower, which I don't disagree with necessarily, you could get back up into that 50, 60 range sometime next year.
Right. I would just say, looking a little further out, I could imagine oil shooting back up again because investment has collapsed, as you know better. Yeah. I don't know how much cumulative overinvestment there is that needs to get worked out, but global growth will pick up. I'm doing this book on the 800-year history of international financial crises. They all end, and the economies grow again, and the world will grow. And on top of that...
So you're pretty confident. The historical record indicates
this too shall pass.
Yeah. Yeah, but also, look, that's thinking about, that's looking at the real price of oil. I think it's going to come under pressure as the developing world starts growing, and we pick up on that at some point in the not, you know, it may be 3 years down the road, but it's not forever. We could see, you know, over 100 easily again. And then you layer on top of that we could well enter an inflationary environment at the end of this because everybody's issuing tons of debt and printing lots of money. It's a little hard to imagine we're not going to be in an inflationary environment, and I think that too will elevate the price of oil.
Right. I think that so many people are, you know, all have the same question really, how did this happen? And it's been progressively, some of the causes that are given are debt, real estate, housing prices, poor regulation, Federal Reserve, central banks, derivatives, global imbalances. How do you all weight the different factors? Is this Is there a primary cause here?
Starting with me?
I'll start with you.
I think you listed all the various factors that mattered. I mean, I think question of nuances, some people will emphasize some of them more than others. Certainly you can argue this global savings glut and imbalances were a factor that kept long rates lower than otherwise and fed the bubble. I tend to emphasize a little bit more, the behavior of the Fed and the regulators. Every time we had a bubble, the Fed wanted to essentially, when the bubble burst, try to ease and create the next bubble. After the bursting of the tech bubble, the Fed pushed the Fed funds rate down from 6.5% down to 1% and kept it too low for too long. And then with the measured pace of increases, did not normalize the Fed funds rate for almost 3 years. I think that was an important factor. I think that this attitude of lax supervision regulation, not just of mortgages, but also of overall credit bubbles was an important factor. The ideology for the last decade was self-regulation. That means no regulation, relying on market discipline, and when there is irrational exuberance, there is no market discipline, relying on internal risk management models of banks, and in this fight between risk managers and risk takers within the banks, the risk managers are always losing because, as the previous CEO of Citi said, when his music is playing, you got to stand up and dance. So nobody's listening to risk managers. The distortion coming from, the conflicts of interest of the rating agencies, and all this financial innovation that without prudential regulation supervision and with the system of compensation and so on led to excessive risk-taking. So all these factors, among other ones, led to this huge asset and credit bubble like we have not seen before.
So housing, in your view, was really followed on from the housing bubble followed on from the lax regulation?
Yeah, but in my view, it was not just, people say this was a subprime mortgage crisis, but it was not just subprime mortgage. It was subprime, was near prime, was prime, was commercial real estate, was credit cards, was auto loans, was student loans, was leverage loans that finance LBOs that should have never occurred, was the buildup of debt of some parts of the corporate sector, was the rise of the debt of the state and local governments. Muni bonds are going to be the next shoe to drop, was industrial and commercial loans, was corporate bonds, was CDSs, was a generalized, it was a subprime financial system, was not a subprime mortgage problem.
You could keep going with the list.
And it was not just the U.S. If you think about the housing bubble, you had the housing bubble in the U.S., you had the housing bubble in the U.K., in Spain, in Ireland, in the Baltic states, in Southern Europe, in Dubai, in the Middle East, in Singapore, in China. So you cannot just blame it on Greenspan and on the Fed. It was a much more generalized global phenomenon where the global asset and credit bubble, and now that's why it's not, subprime mortgages alone cannot lead to the worst financial crisis in the world economy, just $1 trillion of that bad stuff. You have to have something bigger for that.
You have to really work at it.
Yeah. So it was a much bigger bubble.